Good day. My name is Ed McFerran. I'm House Counsel with Tax Deferred Exchange Services. We are a qualified intermediary company that provides services throughout the United States from our headquarters in Tacoma, Western Washington. Today, we'd like to talk about what we call, in our practice, blended property. As you know, if you've seen any of our other videos, an exchanger can exchange out of real estate and acquire other real estate, completing a transaction that will allow them to defer the capital gains tax associated with what would have been a sale of that relinquished property. In many cases, we have clients that not only own investment property, but may also own property that they're using as their primary residence. We call this blended property. Let's assume for just a moment, and assume by example, that we have a party that owns some real estate, and a portion of the real estate is being used as a primary residence, and a portion of the real estate is being used as farmland. The farmer lives on the property and has a section of the property to which they are addressing as their primary residence. Another portion of the property is being used either in their trade or business or for investment purposes. And in the case of being a farmer, it would be used for a trade or business. Of course, the trade or business portion of the property qualifies as an exchange portion of the property. And the single-family residence may also qualify for an exemption under the previous tax laws of 2 out of the last 5 years, or under the new tax laws of 5 out of the next 8 years. And in reality, the question then becomes, if the parties are completing a transaction that is blending together residential property with commercial or investment use property, can they take advantage of a tax-deferred exchange? And the answer is definitely yes. This is a type of strategy that requires competent help and assistance. This is not an area that you'll want to depend upon a general video like this. You'll want to contact either one of our attorneys or legal or accounting counsel in order to help you strategize. Our normal method would be to break the transaction into 2 parts. Of course, the buyer doesn't really care. The buyer is buying all of the property, and in many cases, the buyer is buying the property for, in many cases, development use. And so the buyer really doesn't care whether the property is designed in a transaction that has 2 parts. We would separate the transaction and take advantage of the sale of the property of the primary residence to take advantage of the full $250,000 or $500,000 exemption that's available under the old exemption rules of Section 121 of the Code, or the new modified rules under the 2018 changes under the Trump administration. That would allow the parties to exempt a goodly amount of the capital gains based upon that deduction. The residual value of the property would then be a portion of the tax-deferred exchange, and that residual portion of the property would be part of a tax-deferred exchange transaction, wherein they would take that through the use of a qualified intermediary and take that investment property value and take the funds from that transaction and acquire a suitable replacement property. This does require a bit of knowledge regarding how to close transactions in this fashion. We do find that most buyers will go along what we call for the ride, and the key ingredient will be to separate the transaction appropriately. In our practice, we try to separate the transaction into 2 separate settlement statements, 1 separate settlement statement for the portion that's the primary residence, and 1 separate settlement statement for the transaction that's the investment property tax-deferred exchange. This provides an opportunity for an exchanger to exchange into replacement property or properties that allow them to defer the capital gains that would not have been exempted in the sale of their primary residence. Let's hit one other angle. Blended properties occur in sale properties, or what we call in the trade relinquished properties, but they also can occur in the acquisition stage of replacement properties. Recently, I had a chiropractor who had used a primary residence as a chiropractic office as well as his home. So a certain portion of the primary residence was investment property, and a certain portion of the primary residence was his home. and we determined what percentage based upon square footage was primary residence and what percentage was actually investment use. The same type of analysis applied in the sale of the relinquished property, but interestingly enough, this particular chiropractor wanted to acquire a replacement property that would have the same type of use. He would be able to live in the property, and he'd also be able to use a portion of the property as his primary residence. Why did he want to do that? Well, there were a variety of reasons. One was location, another was size. His practice had grown, and frankly, he had grown out of the other primary residence. And so he found a suitable replacement property that was larger, but allowed him to live in a portion of the property and to have the section below, it was a basement section, to be his studio or his offices for chiropractic work. We had a blended property in the relinquished stage of the tax-deferred exchange, utilizing the same strategies as we talked about before, and we had a blended property in the acquisition stage associated with the transaction as well. This requires a little bit of technical difficulties because in that particular situation, lenders are not necessarily always understanding. So you have to strategize these transactions to make sure that the lender's on board, because in that particular transaction, not all lenders were willing to lend on that particular blended use property. This is not a type of situation where the residential type of Fannie Mae, Freddie Mac, FHA, VA type of lenders are going to be interested. But we were able to accomplish a transaction that maximized the exemption value of the client's sale of their primary residence and also maximized the ability for them to complete a tax-deferred exchange at the same time. It helps us to illustrate one other factor associated with tax-deferred exchanges. You'll notice that the property was used for a trade or business. Many of the people that complete tax-deferred exchanges aren't aware that you can exchange property used in a trade or business as well as investment property. Both investment property, such as a rental, and property used in a trade or business do qualify for tax-deferred exchanges. In fact, our chiropractor could have exchanged into a rental property where he's not using it in a trade or business, he's actually using it for rental properties as well. This discussion of blended properties is general in nature. It doesn't replace the help and assistance that our staff can provide. We're full-time tax-deferred exchange qualified intermediaries. Our staff is available full-time to answer your questions. I highly suggest that you give one of our staff members a call to go over your specific situation so that you can have proper advice, utilizing this video as a source of general understanding regarding blended properties. Good day.